Welcome to the London Property Podcast, your go-to source for navigating the complex and ever-changing London real estate market. Our digital marketplace provides informative and educational content from industry leaders through podcasts and videos. We cover various aspects of the real estate experience, including buying and selling, finance, law, tax, construction, design, and more. Join us as we delve into the latest trends and developments in the market and gain valuable insights from our panel of experts.
Hello and welcome to London Property. I'm your host Farnaz Fazaipour. And today we're delighted to welcome to the show Masood Rashid of Opes, who provide mortgage and financial products to the residential market. Welcome to the show.
Thank you for the invite.
I'm going to first ask you to tell us a little bit about yourself and what makes you a specialist in this sector before we dive in to the questions that I'd like to ask you today.
Okay, sure. Opes Financial Partners, I'm a co-founder. I set up the business in 2011, post-credit crisis, with my business partner, Matthew Davies. We're a specialist, I'd say a specialist mortgage brokerage. We do the normal retail mortgages. We have a team of guys that do all the stuff, smaller ticket stuff up to a couple of million. And then I particularly specialize in private client finance. All of my clients are predominantly international private clients. And then my business partner, Matt, he specializes in commercial, in development and real estate specialists. So we cover the whole spectrum of real estate financing.
Yes. Well, we've invited you to the show today because your approach is very entrepreneurial in how you help your clients and what you do for them. And I wanted to ask you that coming out of an era of really cheap borrowing, and, you know, now we're at a place where a lot of these really low interest rates have expired and people are finding themselves in an environment where, you know, they're paying 5, 6, 7% on a kind of rolling contract. So it's having an impact on the market. And I just wanted to hear from your side, what are you seeing from your side? Is there a lot of fire going on behind the scenes?
Certainly there was. I mean, like you said, we'd come out of over maybe 12 years of very next to zero base rate. Which meant mortgage rates have been around 2%, 1% to 2%, even long-term fixed at 2.5%, for example. And that's been like that for the last 10 years. I bought my first property in 2002, and mortgage rates were at 5.5%. Base rate was around 5.5, 6.
Yeah.
So it was actually more expensive than it is now. But we had 12 years post-credit crisis of very low interest rates. And to be honest, it was a bit of a false economy. It created a whole generation of people used to borrowing very cheaply. And really, if you look back and if you're responsible, a government or the Bank of England were pretty irresponsible, I think, in keeping those rates so low for so long. But since we had these rates so low, and then you've had this inflationary crisis post Russia-Ukraine war, the only way that Bank of England can control inflation is through interest rates. So interest rates jumped up from 0.5% to 5.5%, and that's a massive impact. I mean, it really hit people hard, and it was a bit of a shock treatment. I think it had a bit of a shock treatment in the debt market. I'll give you an example. In 2022, I'd say was our best year ever as a business. And in 2023, we saw the uptake of debt almost halve because people were actually Coutts, for example, in 2022, they did $1 billion of lending. And they told me that in 2023, they did $500 million of lending.
Right.
So that's the impact of interest rates. Private banks were reporting to us that their clients were deleveraging. They're paying off their mortgages. So forget about uptake of mortgages. You know, people are deleveraging. They're getting rid of expensive debt. What was now expensive debt, previously very cheap debt, and getting rid of debt. So that's what we saw. And then on the high street, you went from having a fixed rate of 2.5% to people coming off their fixed rates, let's say 5-year fixed rate, and they're at 2.5%, suddenly facing 5.5%, 6% interest rates. And that's going to have a massive impact on your affordability, on your spending habits, on your whole lifestyle. And this is what we saw. It was pretty. It's a pretty difficult time, and we've helped clients get through it by helping them to refinance, helping them to find the best solutions, and yeah, I mean it's been a difficult time for the market for sure.
And you've seen a lot of people fall out of...
No, we haven't actually. I mean, what's benefited the market is the emergence of the bridging financing world.
Okay.
And this is something that has helped people...
Rescue package.
Yeah, exactly.
Yeah.
So rather than going into default and going into receivership and stuff like that, bridging lenders have been able to come in, offer 12 to 18-month terms, term lending where the interest is rolled up, so there's no debt servicing. And it's given people respite. Excuse me. It's given people some respite during a difficult time. So there's stuff like that that's come in, and lenders have adapted the way they do lending. I mean, the buy-to-let market was hit really hard. I mean, you were borrowing at 75% on a buy-to-let purchase previously because the stress testing on a buy-to-let was pretty comfortable at 75%. Suddenly, your stress test is only affording you 30% or 40%.
Right.
So suddenly the buy-to-let, remortgaging on a buy-to-let has become impossible, right? So stuff like that was going on. So, but we managed to navigate through, and with the help of certain emerging lenders, bridging lenders who have then released quasi buy-to-let products, and lenders adapting the way they lend.
Yeah. I mean, it's interesting you said that, when you bought your property, 5% was the mortgage rate. And I remember likewise, and that was considered cheap.
Yeah.
Because I was coming from a childhood where I'd seen my father face 15% interest rates.
Yes, exactly. I saw the same.
So it was like, guys, this is cheap. So
it's cheap.
Putting us in a bad habit, as you say, for that period of time I remember a friend of mine saying to me once that she was being paid by Bank of Scotland.
Yeah. Yeah.
And she's like, I don't know what I'm supposed to do. I'm not going to touch it in case they ask for it back, because she thought they must be making a mistake. Because
to be honest, I'll tell you so. I mean, the dropping of the interest rate actually, back in 2009, I used to work for a brokerage, and they actually went into administration because business just tanked back in 2009. This is post credit crisis, and looking back, it's one of the best things that could have happened, because that was the birth of Opes for me. But at the time, it was incredibly difficult. I went through an incredibly difficult time. My eldest son was 6 months old, and I basically lost my job. The company that I worked for has gone into administration. And the thing that saved me was the dropping of the interest rates, because they went from 5.5% to 0.5%. My mortgage costs went from £2,500 a month or whatever it was to 250 quid.
Yeah.
And the timing of that was amazing for me at the time, and it really helps. And that was a godsend, really. And it helped me to start a business in a very low interest rate environment. And then suddenly, because of that, we had this influx of people coming into the UK, buying property, super cheap money, and everything started to boom again. So we really benefited from that. But I think the mistake was to keep it so low for so long. We had that initial thing which brought us out of a crisis with the credit crisis, but then and then they should have been I think tapered it up a bit more gradual. But then again, you look at going from 0.5% to 5.5%. I think the shock of that does impact inflation, and obviously it worked with the inflation coming down from 11 to, during the Conservative era, down to like 2.5, 3, whatever it was. So there was an impact on affordability, and it did help that. But I think now things are normalized. I think they're coming down to what will be a new norm, which will be around 3%. I don't think it should be any lower than that, maybe 2.5%, 3%. and people are adjusting to it now. They're getting used to living with higher cost of mortgages. And so the demand is coming back again. It's creeping back. You know, the initial shock was there, and there was a sudden, like, you know, deleveraging. There was suddenly, you know,
deer in headlights.
Yeah, exactly. But now people are settling to a new environment of life. It's now 4%, right? So it's not so bad.
Yeah.
And now, it's going to hopefully get lower. If we end up at 3%, I think that's great. And it's good for borrowers and for savers.
Yeah. So here at London Property, we help people manage property wealth, and we report on everything that could affect them. And one of the things we do is we do news bulletins every week. And I keep reading about mortgage products changing, longer term mortgages coming in. And I remember when I first bought my property, I put down 20%. I got a long mortgage, and, you know, everything was hunky-dory. Are we going back to a time where there'll be new mortgage products that will help people get onto the property ladder with smaller deposits, with affordable monthly payments? What's happening there? Because there seems to be a lot of talk about that.
Yeah, that time's already here. So you're right. When I first bought my property, you could borrow 120% of the purchase price. And that was, again, 2002. And it was a different environment, obviously, you know, 20 odd years ago, you know, where we're buying properties at a fraction of what we're paying for now. So even though the interest rates were 5.5%, 6%, and you could borrow at 120% of the purchase price, the affordability was there. It was an affordable situation because the property values were so low. Now you have higher property values, although it's very interesting what's happening now with property values in prime central London especially. And, you know, people are talking about prices at 2012 times, you know, and that's what we're seeing, you know, in certain prime locations. And what lenders are doing, and it's already out there, for example, Accord is a mortgage lender that lends at 99% borrowing, 99%. So what happened? I'll go back to credit crisis. So when the credit crisis happened, all of that high-risk lending, which was regarded as high-risk lending, was pulled. All the 120%, all the self-certification mortgages where you didn't have to prove income, which was really driving that boom, that property boom in the late 90s.
Right.
All of that stuff was pulled, and it all became much more conservative lending. Banks became a conservative in sort of late 2010 when the mortgage lending came back. It was much more conservative. LTVs were lower. Rates were cheaper, but borrowing, you couldn't borrow like 80, 90, 100% then. Now, with the rates gone up, this new environment, lenders are coming back with higher LTVs, like 99% Accord. I think you only have to put down £5,000 as a deposit. And there's different ways, different lenders are coming in where they're testing affordability differently. So, for example, there's a bridging lender called West One. They've released a residential product, which essentially they look at the client's net income, they look at expenditure, and they don't do a multiple cap. So it's no longer 5 times income. As long as you can show that you can afford it, then the lending is available. So, and that could go up multiple times. There's no cap on the multiples. It's purely based on affordability. So there's different ways that lenders are approaching this type of lending, and hopefully that's going to evolve with the market. I think there's no reason why it shouldn't evolve. I mean, markets evolve, you know, products should evolve, and mortgage lending should evolve. So that's something that we're going to see more and more.
Yeah, I've been saying that for a while now, for a couple of years, that, you know, for us to see a real change in activity and people coming back to the market, you need mortgage products.
Yeah, 100%. Yeah. Because at the moment, there's a lot of purchasing happening in prime central London especially, which is cash driven. And if you have debt combined with the cash, obviously then the expenditure is much bigger. So at the moment, the market is restricted to a lot of cash buyers. I'll give you an example. So prime central London the market has been very much cash driven. So imagine if you have debt involved, affordable debt involved in that market, then the appetite will increase because the affordability will increase and the ability to buy more will increase. And but if you look at, for example, last year or even this year's statistics, we worked with a firm called Sotheby's International Realty, and they had something like $1 billion of sales last year. This year, in the first half of the year, they've done something like 600 million. Now, only I believe it was 80 to 90% it was cash, so only 10 to 20% mortgage driven.
Right.
So if you imagine you have a market where there's good, affordable mortgage lending, and then suddenly you're not cash constrained, so then the market can expand. It's just logic, right?
Yeah.
So that place is coming. You know, it's coming where mortgage lending will come back and complement
The
sales.
investments.
Yeah, hopefully. I mean, there's been many things that have happened. Obviously, the non-dom situation. We've had an exodus of wealthy people from the UK, and they've gone to tax havens like Dubai and Milan and places like that. But hopefully, when we're in a better environment which is friendly to wealth, we'll see the market expanding and debt prices and costing coming down and the market again,
picking up. I mean, I do sense that there is more going on.
Yeah,
I really
there
do.
is. I think so. We're seeing the transactions. We were heavily involved. It was predominantly refinancing when the whole credit cost of credit went up, and we're just helping people restructure and keep out of problems. We're seeing now more acquisitions. I mean, I financed. It was one of the largest purchases in London at the time, a couple of months ago, and it was a £28 million house in Knightsbridge, which we acquired debt for the buyer at 21 million, 75% at close to 4% fixed rate, which is, I think, it's great. It's a great product. It's an amazing product. You can't think about the past. The past is gone. These 2% 5-year fixed rates have gone, forever gone.
Yeah.
And you just have to just look at the market now. What are we in now? 4% is not bad. It's not something that's unreasonable.
It was good in our day, right?
Yeah, exactly.
The other thing that I've been reading about in the press is that the whole approval of mortgages and lending is going to be modified, and they're looking at simplifying how to approve people. So, for example, if you've been renting for 20 years, you've shown that you are able to make that commitment.
Yeah.
And nobody's actually ever taken that into consideration before.
Yeah.
But we're reading that this is something that they're looking at doing, and they're looking at getting the approval of mortgages to be more flexible. Would that be the right word?
Yeah, it's out there. It's being floated around. It's very much theoretical at the moment. I believe there's one lender, although, don't hold me to it, but I believe that one of my team told me that Skipton is doing this thing. But what he said was, the other conditions are so stringent, it just doesn't work. So at the moment, it's not a practical thing. It's very much theoretical. It's not in practice, but the idea, it might be a good idea. I mean, if you can afford to pay the rent, you can afford to pay a mortgage at a similar level, and if you got proven track record. But then I can't see how that would change, because if you can afford to pay the rent, then it would be based on a certain income level of affordability. And there are lenders who are looking at, like I mentioned, West One, who are looking at purely affordability. So they're looking at what's going out, what's coming in, what's going out, and then can you still afford the mortgage after that? So I guess there are different methods of being able to achieve the lending, different approaches, and it's all welcome. It's good to talk about it, and it's good to create ideas and have ideas and make suggestions. I mean, the buy-to-let market, what the buy-to-let lenders did is they could, because they have these restrictions based on rent stress testing. So what they did is they lowered their rates to below the base rate, fixed rates at below the base rate, and increase their product fee to be able to work on the stress test. So they justified the stress test through having very high fees, sometimes up to 7% fees, right?
Right.
Setup fees to have a, let's say, 3.5% product, and which would then be sustainable on rent, right? So there's stuff like that happening. So lenders are being a bit more clever in how to get the business back in.
Okay.
And there is an appetite for lending. The banks do want to lend.
Yeah.
If you're doing, for example, Barclays Private Bank, they told me, where our target is to do net zero lending. I mean, which to me is ridiculous. It's just basically money, the amount of debt that's repaid and the amount of debt that's being uptaken or released or whatever. But their position is that if they do net zero, they're happy.
Right.
Net zero, it's just ridiculous. But so lenders are hungry to do debt. The lenders are out there. We're doing a lot with the private banks. I do a lot with the private banks. There are a few that are very active and proactive in making it easier to do business.
And they really look at the individual, and the situation is very much a bespoke case by case, isn't it, when you're going to a private bank? Whereas when you go into a high street bank, it's kind of the regulations dictate exactly what you can and can't do.
With the private banks, you have what's called high net worth exemptions. So you have to qualify with having a certain amount of liquidity and net worth. You have to have a certain level of income. And then you're essentially saying that the banks are essentially saying that you're not a typical sort of retail customer based on income and affordability. You have other assets which could repay the loan if you needed to, and all this kind of stuff. So it's treated differently. And yes, so it's treated very much more individually.
Yeah.
And there are clients that's wealthy people who don't necessarily show a lot of income. They have a lot of expenditure going in their businesses or whatever, and they don't necessarily show a lot of income, but they have a lot of assets. We can still get lending for them. It's more of a holistic picture on their net wealth and income.
Yeah, one of your competitors in an interview told me that they were using somebody's really expensive cognac collection as collateral.
Right, okay. Yeah.
Let's hope he doesn't drink it by the time it finishes.
Yeah, exactly.
So if you were to give advice now to our listeners, both to those who are in debts that are uncomfortable and those who are looking to plan what to do, what would be your best advice in this environment?
Yeah, so if you're in a rate that's a fixed rate, which is still currently low from a previous era, then
stick to it with dear life.
Yeah, I mean, first of all, but start the research process early.
Yeah,
I'd say 6 months lead time prior to a fixed rate coming off, just so you can start adjusting yourself anyway, and you can speak to a broker and get some illustrations of what it's going to look like at present rates that are being made available. So there's stuff you can do to start to prepare for the hit, and it will be a hit, especially if you're still on those products. I remember giving clients 10-year fixed rates at 2.5, 2.6% with someone like Coutts, for example.
Yeah.
And those loans are still at that level, So once they come off, then it's going to be still going to be a bit of a hit for people that have large loans and now having to pay high interest rates. I mean, I went through it myself. I went from having a fixed rate at 2% to fixed rates and now 5.5% and that kind of thing.
So my 0.5% above base, I should hold on to for dear life.
Oh, you have a margin of 0.5% over base.
I've got a property that's 0.5% above base. Yeah.
Yeah, so your rate would have jumped up, right? Your rate would have jumped up when it went up to 5.5%, the base rate.
Yeah.
And now it started to come down. So a 0.5% margin, it's decent.
It's decent.
It's decent. You can still get below 1% margin.
It would have been better if it was fixed at 0.5% above it.
Yeah. If it was fixed, that's fantastic, right? But you've obviously had to ride the wave with the increase in rates, and but hopefully now you'll benefit from it coming down. But 0.5% margin isn't abnormal now in the market.
Okay.
There are 0.5% margins
we've
out
gone
there,
backwards.
or less than 0.5%.
Yeah, yeah.
You know,
But we've gone from me looking down on my bank statement, wondering if it was a dinner or my mortgage, to, okay,
Yeah.
now it's definitely my mortgage because it literally went up
Yeah.
7-8 times or something.
yes, so many people had that.
Yeah, yeah.
Yeah, so I had the opposite experience, but this was back in 2009. I'm sure you had the experience as well, where we went from a mortgage rate which was, back then the margins were below the base rate. I remember the mortgage rates, they had margins below the base rate, and which was amazing, right? So when the base rate dropped, you know, I had a rate which was sub the base rate.
Yeah.
At almost
Like my
zero,
friend who was
almost
getting
zero.
paid.
Yeah, that's
Yeah.
when they'd get paid.
Yeah, she was
That's
getting
when they were
paid
getting
£300
paid.
a month, and
because
she's
she
just like,
had
I don't know
something
what's
below
going
base.
on.
Yeah, she had something below base.
Yeah.
That's a good margin below base, and that's because back then the lenders were just packaging and selling the debt.
So to the people who are looking for debt now, what would be your advice as to the best thing to do?
Well, always speak to a broker, a
Yeah.
whole of market broker.
Yeah.
If you're a first time buyer, there's many different options. Like I said, there's income affordability testing is different now. Just be comfortable with what you will have to pay.
And should you go for longer term? Should, you know, what would be
we're
a wise...
advising, my advice at the moment is to go for short-term fixed rates,
Yeah,
2 years,
yeah.
because at the moment we're on a downward trajectory, and so we're expecting base rate to come down. So lock in for the short term, and then in 2 years' time, we hope that we will be at maybe 3 in 2 years' time, or below 3. And as long as it's not a global crisis somewhere, but hopefully we'll be below 3 below 3. And then you lock in for the long term when we hit that level, and just lock in
Right.
5 years or whatever. And then at least then for the next 7 years, you've sort of planned
You
it.
know what you're doing.
But yeah, I mean, it's so difficult to tell. And there's so much upheaval out there, and so many things that are impacting our lives. And but that's what I'm advising. I'm advising 2 year fixed for now, and then refix in 2 years' time on hopefully a lower product.
And before I thank you for your time and say goodbye, I've got one more question for you. So there's a lot of foreign investors, as you say, at the moment in the market, looking to buy properties with slightly different exit plans. But if you are looking to put together a portfolio of properties in this current climate, to put together a portfolio that you're going to let out, maybe hold for 4 years, what would be the minimum equity you need to start building up a portfolio?
For a foreign investor,
Yeah.
they can borrow up to 85, 90%.
On a rental portfolio?
Not on rental, personal use.
Personal use. No, I'm talking about people
personal use.
who, there seem to be people actively putting together
If you're
rental
looking at-
portfolios.
Yeah, so if you're looking at investors, real estate investors from overseas, is that a specific question?
Yeah.
Real estate investors from overseas, I would say you're looking at realistically 65% as a loan to value on a purchase of a buy-to-let type of property, or if it's a block of flats or something like that, then 65% would be more realistic.
Okay.
And real estate is kind of capped at that level. But for personal use, for a foreign investor, up to 85%, you could even push it to 90% as long as you can amortize the loan down to a comfortable level quite quickly. But we're seeing some decent lending at decent LTV.
And is that changing much for onshore investors, or is it more or less in the same ballpark?
No, onshore investors, you have more options, obviously. The market is more geared towards onshore. And you have these price products, like I said, which have very high arrangement fees where you can push the LTV higher. So there is that stuff out there. But the products, new products coming on the market all the time. And the options for international and domestic, new stuff coming on, so it's important that you've got a good mortgage broker and who are on top of it in terms of what's out there. The type of stuff that I do isn't something you just tap into a computer and it gives you rates like you can do on website searches or whatever, or what the majority of retail brokers. It's all about product knowledge. It's all about knowing who's doing what out there and being on top of that. And so that's very important. And I think that's something that we're very good at.
Yes. And I think for our listeners, what's really important is to take this advice from experts early enough to plan, and also don't be frightened. There are solutions.
Yeah, there's always a solution.
There's always solutions.
That's one of my mottos. There's always a solution.
I actually get comforted when I speak to a mortgage consultant when I'm trying to deal with my own issues, because when I'm thinking about it on my own, I get more anxious than when I actually speak to someone. They're like, "No, it's no big deal. You're only this, you're only that."
Yeah.
So it is reassuring. But we are going back to an active market, and we look forward to welcoming your partner back on the show, because we'd like to also have this conversation more on the commercial side and what's going on.
Yeah, absolutely. He'd be delighted
on that side. So thank you so much for your time. And should any of our listeners need any help with financing, refinancing, then do please reach out so that we can put you through to the right specialist for your requirement. Thank you so much for coming today.
My pleasure.
Thanks for tuning in to our latest episode of the London Property Podcast. Head over to our website where you can browse our exclusive network of top experts driving the market. As a member, you'll have direct access to our experts and their networks. Our award-winning content will help you choose the right professionals for your needs and make informed decisions about your investments. Personal recommendations are a powerful tool in connecting with trusted professionals. Let us introduce you to the right people to help you achieve your real estate goals. Contact us now to learn more about becoming a member and gaining access to these valuable resources, or joining our directory of experts.